Peak Wealth Management proudly presents Finding True Wealth with certified financial planner Nick Hopwood and accredited investment fiduciary Jim Pilat. Nick and Jim believe by making simple, good financial decisions, you can retire with confidence. And now, let's turn it over to your hosts, Nick and Jim.
Welcome everyone to episode 82 of the Retire with Confidence podcast with Nick and Jim. I am Jim Pilat.
And Nick Hopwood.
Yeah, a little role reversal today. I'm going to do some interviewing of Nick. We realized earlier this month that Nick celebrated his 20 years in the business. Congratulations.
Thank you.
It's quite a milestone.
Yeah, a lot of gray hair from back in the day. We're going to publish a picture from today and then 20 years ago.
Yeah.
And a collage side by side so you can see the difference.
Yeah, it's worthwhile, folks. I would make sure you don't miss that.
You know, the best part about it, if you look really close on the teeth.
Yeah.
When I was 21, I had braces.
Yeah.
So, I was in college, right?
Right.
I got licensed when I was still in school. So I was had braces when I was a senior in college and drinking a lot of beer back then. And the rubber bands would turn yellow, like with the yellow, like stained. And if you look really close, it's not yellow teeth. Not that I have the whitest teeth or anything, but they're not yellow teeth.
No.
So, yeah, kind of a funny story. I used to go to the dentist or the orthodontist every week on Friday and have them switch out the rubber bands.
Oh, yeah.
I think they love that.
Sure. Yeah. It's creative.
Yep.
Well, anyway, we thought it would be a good opportunity to reminisce a little bit and talk about what things were like 20 years ago. I feel like the business has come miles and miles from where it was then. And maybe this would be a good opportunity to kind of highlight some of those things. Yeah,
it's fun to think about how things were and how things are now, for sure.
Yeah, absolutely. Anything stand out to you as biggest area? Maybe technology, I imagine, is something that changed quite a bit.
Yeah, my favorite thing about technology was the Quotron machine that we used to have back at the old office on Center Street. Okay. So I don't even know if that's what it's called, but that's what I call it. Yeah. Quotron, imagine we have a satellite on the roof and then a special room dedicated to this machine.
So it got its own room, huh?
It looks like it's like its own computer, okay?
Yeah.
So it looks just like a monitor with a keyboard, but there's a satellite on the roof which connected to this computer, and basically it would give you quotes of the stock tickers and the indexes and such, and like some news, and it was pathetic. It was like hundreds of dollars a month, and when I started working, I said, look, let's use Yahoo and Google and you use websites and pay subscription services to get a streamer on your real computer, so you don't have to walk. You have to get up from your desk and walk over to another room to get the quote. It's ridiculous.
Yeah.
So that was a funny thing. We don't, we ditched the Quotron machine, right? We don't have that anymore. Yeah. We used to have to call in to place stock trades or mutual fund trades. We have to call, in the Ameritrade trade desk or the LPL trade desk.
Even as the advisor, huh?
Yeah, the advisor, yeah. So at that time, about 20 years ago, we were really coming online, but the systems were bad. Yeah. We could start placing orders online, but a lot of them were still done on the phone, which I think is ridiculous. Now, for a do-it-yourselfer, right, they would have to call in and pay hundreds of dollars.
Yeah.
Hundreds and hundreds of dollars for stock trades. And the costs on those now are free.
Yeah, that's what I remember back 20 years ago, picking up the phone, Comerica discount brokerage services or whatever, and thinking, we were dirt cheap prices, paying $50 a trade.
Yeah, 50 was pretty good, but that was you'd still pay $50 for like $1,000 order.
Yeah,
right. That's 5%.
Yeah, it's huge.
And so Ameritrade, E-Trade, they came out, $10, $20. I always remember a commercial. Must have been like 1999 or something. There was this guy like, playing with his kid on the lawn. It was an Ameritrade commercial, and he's like, $8 a trade. Man, I never thought I'd see the day.
Yeah.
So I guess $8. And it stayed that way for a long, long time until last year when everyone jumped on the commission-free train.
Yeah.
Right. So free ETFs, free stock trades.
That was a big shift for sure.
Yeah, for sure.
Yeah. What about as far as workspace? Right. I mean, back then it was big old desktop, like you said, making phone calls and everything. I mean, now the advent of the iPhone. And smaller technologies.
Yeah, I mean, we could run the iPhone. We can run almost the whole business from the iPhone.
Yeah.
It'd be less optimal, but it really can do almost everything.
Right.
So you've got, number one, you make your calls, right? You've got your email. You've got your access to Ameritrade and other strategic partners that we use. And then from a client perspective, right, they've got the app, right, the advisor client app, where they can look at everything in the palm of their hand, or the planwithpeak.com mobile site, where they've got their financial plan in their pocket, right? So those are two things that, from a client-facing perspective, is a huge difference. Because back then, you were just making phone calls with your cell phone, and everyone had a landline still. That was still the main deal. Everyone had to have a landline because you had dial-up internet.
Right.
Right?
Yeah.
So you had to have a landline. And, I remember when my mom had her cell phone, it was never on. Right? When I needed to reach her as a kid, this is like early 90s, right?
Yeah.
I call my mom and it's always off. Right? Well, she would only turn on her cell phone when she had to make a call from the road.
Yeah. Remember you used to buy minutes? You probably only had,
oh, man,
a couple hundred minutes a month. And...
What? So this is like 1998 when I was in college. I'm always like on the edge, on the cutting edge, Right? So I had a cell phone, that little Sprint PCS StarTAC phone.
Oh, yeah.
That like you kept on your belt, and it was like so cool.
Yeah.
Everyone wanted one.
That was, That was the thing, right? Phones went really, they were big, then they went really small, and now they've gotten big again.
Yeah, right. It was really small, and it was really cool looking. Everyone wanted one, and they were like $400 back in 1998. And I was working at Emden, like selling Michigan sweatshirts and stuff, T-shirts, and I didn't need it,
Yeah.
Because then you had to pay $50 a month for the subscription. And let me tell you this, I had the minute plan. This is hilarious. So it was the student minute plan. There was no texting. There's no mobile internet. It was just calls. Okay. So it was like $50 a month, and you had 72 minutes. 72 minutes for a whole month.
That's funny.
Okay. And get this, the first incoming call was free. The first minute was free. So I had a buddy, his name was Nick as well. And whenever you called him, he would say hello, and then he wouldn't even say hello. He'd say, "You got 1 minute," because
to save him up,
because he didn't want to cost himself a minute.
Yeah.
The 72 does not go very far.
No, you can run through that pretty quick.
And now here we are, running the whole business on the iPhone if we had to.
Yeah.
On vacation, I do that a lot.
Yeah, it's definitely made being out of the office. We're not out of touch. Right, you're still in touch even if you're out of the office.
Right. One other thing with technology is TVs. We have like 5 huge TVs in the office here, and we use it as signage, as business news for presenting analyses. Yeah. And back then we didn't have any TVs in the office, and to the point that really illustrates this is 9/11. When I was September of 2001, September 11th, I actually was at a seminar because 529 plans were brand new. So I was at a seminar like at the Novi Hilton. It was the Novi Hilton back then, learning about 529s, doing some continuing education. And I was driving back and listening to the radio, and everyone was kind of freaking out about the World Trade Center, smoking and on fire, and no one knew what happened. And I came into work, went straight to work, and turned on the radio, and listened more. Tried to go online to like the news outlets like CNN.com, and they didn't exist. They were crashed because everyone was trying to go to the news
Couldn't handle
website.
the volume, huh? Yeah.
every website was down. So I tried all day. You know, the market was closed. There was like nothing to do, right? But we had to be open, and there was no way for us to get information. Now, with technology today, right, it would be unheard of to have all these websites crash at the same time. But also with these 5 TVs we've got, you know, we have TV that we can watch, right? So, you know, small thing like that makes a big difference with an event where you're trying to get information. I remember still driving home, and the first time I got the visual of the World Trade Center was at home once I turned on the cable news, you know, and just glued to it.
Yeah.
That much more because you were just imagining what it was like.
Yeah, it definitely illustrates the point of how much more accessible information is now.
Yeah, that's right.
You know, we talked about that a couple of podcasts ago with the market and how quickly everything was moving.
Yeah.
And it's just information moves instantly, it seems now.
Sure does.
Yeah. What about markets? How do you think the markets looked back 20 years ago as opposed to today?
Well, the biggest... I mean, markets are markets. They're always very similar. There's maybe always a different narrative. But the narrative back then was the new economy, right? The dot-com boom. So companies that made things, you know, like manufacturing, other industries like that, no one had any interest in investing in those. It was all about the tech boom and the dot-coms. But we know what happened there, right? Everything fell apart in March of 2000. And we had that bear market, which lasted, you know, until 2000, 2001, 2002, like almost a full 3 years. And that was basically my first 3 years of being licensed.
Yeah.
Technically, I was licensed in like September of 2000, but I was still in college.
Okay.
Yeah. So there's like this staggering for me when my career started, because I started at American Express Financial Advisors, not licensed, but during college in 99. And then in 2000, I was licensed. And then in 2001, graduated from Michigan working full time.
Okay.
Yeah.
A couple different phases.
Right. So we just call it 20 years, you know. Right now it sounds good.
In the ballpark, yeah.
Exactly.
Right.
Yeah, so the internet boom and bust, that's what I remember vividly back then.
Yeah. That was an era too where markets moved really quick, right? Where we would see the tech stocks, dramatic rise day after day after day for a while.
Yeah, they were definitely headed for the moon.
Yeah.
It was exponential. Yeah. And then it was, you know, just like we're seeing with the charts that we're looking at with the virus, right? Ramping up, and then the expectation with Farr's law is that it ramps back down the same way, kind of like this.
Yeah.
That's how those internet stocks were back then. Yeah. I guess that, you know, that type of pattern repeats a lot in history.
Yeah, we've seen it for sure.
Yeah.
The one thing that stands out to me that is being, you know, remarkably different, and we talked a little bit about this, but is costs, right? We know trading costs.
Yeah, we talked about that.
Have changed,
but also rippling throughout the entire industry at every level. Fees, costs, commissions. So, you know, back then, you know, you had mutual funds were, you know, huge in the industry, and oftentimes in the advisor world, they had a sales load, so basically a commission.
Right.
And even before I started, you know, the commissions were coming down, but now, fast forward to today, almost no one pays a sales load. You know, it's like almost unheard of. Almost taboo. And we run into someone like a competitor like that very rarely that's charging commissions.
Right.
So you have commissions going away in favor of advisory fees. Right. And when I started, we were predominantly advisory fees. I think everyone else realized that was the way to go.
Yeah, I guess so. You have an interesting viewpoint of seeing both eras, though, right? Where you started in a dominated commission business as opposed to now. Do you see
that was like a really big talking point for us back in the early 2000s? Well, we're fee based. Now, like it's a given,
right?
You know, but we were ahead of that curve there.
Yeah, that's yeah. To be fee based back then is you definitely were ahead of the curve.
Yeah. So then also, so you have the sales loads of mutual funds, and then you have the expense ratios of mutual funds, and those also have come down dramatically. So I want to say that back in the day they were like well over 1%, maybe like 1.4% was an average mutual fund expense.
Yeah.
And now it's, I don't know, we use a lot less mutual funds now, but it's probably under 1%.
Right. Even looking at no load mutual funds, right? Those were really common to see those well over 1%.
Yeah.
And a lot of those have worked their way down some.
Yeah, I believe it. So we have the expense ratios, but also I think part of the reason why that's been coming down is because of ETFs. So the exchange traded fund revolution, and my prediction would be that in a few years, like, ETF assets will be much bigger than mutual funds. And we've shifted our practice dramatically in that favor as well, in favor of ETFs as well, for many cases. Not, I don't want to say exclusive, but for many cases we're heavier in ETFs. And one of the nice things about the ETFs is the expense ratios.
Yeah.
Some of those,
much better.
It's kind of rare to see an expense ratio on an ETF higher than 0.3 and as low as like 0.03. Right. So you're comparing, 0.1, 0.2 on average maybe to 1% of a mutual fund, maybe a little less than 1%. It's like 10 times more.
Right. And even against 20-year ago prices, you're talking, 1.4. So, I mean,
right.
It's an even more dramatic difference.
Exactly. And so, come to think of it, one other huge shift was back then all the mutual funds were actively managed. No one cared about the index. And now it's super heavy into the index.
Yeah.
Right? The passive style. So we believe in active and passive, but we do it different ways, right? In some cases, we have a passive ETF alongside a mutual fund. And in other cases, we use all ETFs with strategist over the top. So that is adding an active layer to it.
Yeah.
Right?
Yeah, that's a good point. You don't have to have an active stock picker to be an active investment.
That's right.
Yeah.
Absolutely right. So also, advisory fees, they were higher. Okay. So, I mean, I've seen advisory fees over 2%, and you're just like, what's going on here? And so those have come down as well. And we talked about the stock trading. So those gone from hundreds of dollars per trade to nothing.
Did you used to see advisory fees and trading costs on top of it?
Yeah. So you could have that. You could have layers upon layers.
So the client's not only paying the advisory fee, they're paying the transaction charge and everything. So,
but not a commission. It was a transaction charge.
Correct. Yeah.
So there'd be, let's say, an advisory fee of 1% or more, and then a mutual fund expense of 1% or more, and then transaction charges as well. And these transaction charges would be like $15 per trade. Okay, but it could add up if you have an active account.
Yeah. And
right now, it's just the way that our business model works. It's like advisory fee and very low expense ratio. And that's the business model that we want to be in.
Right. Tremendous amount of fee compression.
That's a great way to put it. Fee compression.
Yeah. It's been a big change for sure.
Yep.
What about the industry? What about I think of competitors. Who did you compete with back in the day? Who were the other big names?
Yeah, I mean, there'd be names that you all recognize, but the industry was dominated by what we call the wirehouse firms out of New York, and that's changed significantly. I mean, big time. So, if you think about this, right, people's career paths, right, they started off at the wirehouse as an employee working for the mothership in New York, okay, and then after they had success and realized, well, maybe I want to do things a little bit different. If I stay where I am, I can't. If I leave and go independent, I can, have my own business and do things my own way. So you leave the wirehouse and you go independent, right? And you're kind of going on this path here, okay? And I think that gravity is just taking everyone this way. That's why I'm saying we're going down. So you go from the wirehouse to independent. And then independent is great, but you still have, some things that are not optimal, right? Like maybe a higher cost of doing business, maybe not access to all the great technologies, maybe an old platform with an old way of thinking. Okay. And so people have gone from independent to RIA, which means Registered Investment Advisor, and that's where we are, Registered Investment Advisor. And in 2015, we made that jump, and the whole theme was more for less, right? We want more. We want more technology. We want access to more. We want all of that for less cost. Like, here's a great one. Okay. Back in the day, at these wirehouse firms, you'd have $100 per year IRA fee.
Yeah.
This is such a garbage fee.
Right.
They're just,
you would see those though for sure.
yeah. And where we were, they were like 45, I think. And people hate it, and I hate it too.
Right.
I mean, it's the worst. Okay. And so one way of forward thinking is just, why do we have this? And it's a garbage fee. Let's eliminate it. So when we chose to leave independent and go RIA, you know, Ameritrade, TD Ameritrade was a great partner, and I still feel like it's a honeymoon phase 5 years later with Ameritrade, because the platform, the fees, the culture, the service, all of that. And so this has been this, you know, gravitational pull to RIA. And so we're not the only ones doing this. And this is the only space in the industry that's growing, you know, with any meaningful growth. So the culture of the RIA is CFP, you know, Certified Financial Planner, fiduciary, always acting in your client's best interest ahead of your own, always. And did I say planning?
No, not yet.
Planning,
Yeah,
okay.
planning.
You know, the planning, the CFP, right, the Certified Financial Planner, I feel like, you know, we are the CFP making those recommendations, what to do, behavioral. Should we save this? Should we spend, save, pay off? You know, how much should we put into the 401? How much should we put against the mortgage? Are we saving enough? Are we going to have enough? When does the money run out? What's the Monte Carlo probability of success? Right? All these things helping people understand that, yes, I do have enough. And if I keep doing what I'm doing, I will be on the right path. Or if I'm not, I have to change this, and this, and then I'll be okay. That's what I love to do more than anything. You know, the investments, right? We help obviously with the investments as well, and they are one piece of the big plan. But we want to help you with that whole plan, and that's really what I think is the common denominator with all the people who eventually end up here in this RIA world.
Yeah, that seems to me to be a big deal, right? I'm picturing 20 years ago, you know, the wirehouses and companies like this being very product driven and buying, buying the hottest fund or buying the best
product of the month.
Right? And not, you know, it all works out in the end, right? As long as I get you the best stock going, right? And in reality, we know that that's not a good model.
Yeah, I like to say that we don't sell any products. We just sell ourselves as a partner, you know, as one of your strategic partners, and as a coach that's in your corner. And, you know, we're not selling anything. We're just going to be here for you.
Yeah, that's great. It's been really interesting, I think, to see this 20-year evolution, and you got to see so much of it firsthand. So many interesting markets.
Starting to feel old.
I know, right? But starting with the tech bubble, you know, going all the way through 2008 and what we've seen here recently, I mean, there's a lot of experience you've gained in a 20-year period. Yeah,
and you know, you saw that 50-plus decline in 2000 to 2002, 50-plus decline percentage-wise 2008, 2009, and now we had 35%. You know, hopefully that's it.
Yeah. For
the virus, and each time, you know, like very painful, right? For me as well.
Oh yeah.
Okay. So, but I do feel, you know, a little bit more wise as a result. But a wise man always knows that there's always more to learn, right? So I can say that been through the third one now here, or I'm sorry, maybe still in the third one, but having those two to reflect on about how I felt, about how clients felt and respond and react to different things, and reading so much from smart people, right? And understanding and be forward thinking, like what could happen next. Let's not be surprised, right? And controlling how we respond, because our behavior is really the only thing that we can control, right? So you just don't want to shoot yourself in the foot in a time like this.
Yeah, but I think that experience is really valuable, being able to see and feel what it's like to go through a big drawdown in a bad market. Because we, as we talked about a couple of weeks ago, I mean, emotion is such a big driver when it comes to making investment decisions. So having that experience of understanding that emotion, I think is huge. It's critical.
Yeah, the emotions are powerful for sure. And this time actually was quicker. Those other two ones were long, drawn out, and this one was, at least so far.
So far, it's been really quick. Yeah.
The magnitude hasn't been as deep, but the velocity has been worse.
Yeah.
Different storyline altogether too. Yeah.
For sure. Great. Well, you have any parting thoughts for us? Any? You kind of hinted at where they think the future's going.
I don't know where I don't know. I don't have any big 20-year predictions.
Yeah.
No. I'll tell you what though, if every month was like the last month, I don't think I'd make it 20 more years.
Yeah.
But I don't have any predictions over 20 years. Maybe Alexa will have something to do with it.
Oh yeah.
I mean, that'll be my prediction there. But I'll tell you what, if you want a second opinion, right, call us, look us up at peakwm.com.
Yeah. And
you can even schedule an appointment online, and we can put some of this experience to work for you.
Yeah, sounds great. Thanks, Nick, for sharing, reminiscing with us a little bit today. And
thank you for participating.
Yeah.
You've been listening to Certified Financial Planner Nick Hopwood and accredited investment fiduciary Jim Pilat on the Finding True Wealth podcast, sponsored by Peak Wealth Management. You can learn more about Peak Wealth Management by visiting peakwm.com or follow on Twitter at nhopwood1.